Hello everybody, and welcome to another edition of the ITPM Flash. I'm Jason McDonald. I'm a senior trading mentor at ITPM. Now, I don't often focus too much on currencies, but this year I find myself watching them more than usual, especially the US dollar. For instance, the Taiwanese dollar, obscure, I know, bear with me, the Taiwanese dollar rallied more than 10% against the US dollar since April, and it spiked up aggressively at the end of last week and the beginning of this week. Here's the chart. As you can see, a very aggressive move. So the Taiwanese situation is an interesting one. They've accumulated $1.7 trillion in FX reserves and overseas fixed income securities, mostly in the form of US Treasuries. That's more than 200% of Taiwanese GDP. 1 trillion of that is held privately, and the other 700 billion is owned by insurance companies. Insurance companies have got stricter regulatory requirements than pension funds. Now, an FX mismatch is where the currency of your assets and liabilities don't match. So Taiwanese life insurers have got US dollar assets and Taiwanese dollar liabilities. The FX mismatch for those life insurance companies is approximately $450 billion, or 60% of Taiwanese GDP. So the currency of their assets and liabilities don't match, i.e. they've got US dollar assets and Taiwanese dollar liabilities. 200 billion of that $450 billion fixed income exposure is unhedged in US dollars, and that is about 25% of Taiwanese GDP. I think you'll agree that's quite a significant amount. Now, here's a chart of the Nasdaq 100 against the DXY, which is effectively the US dollar trade-weighted basket. As you can see, currently, the Nasdaq is down about 4-5% year to date, having had a rather impressive 18% rally off the lows. The dollar, however, is still 9% down year to date, as measured by the DXY, and hasn't really bounced. So, the pain, really, if you're a Taiwanese insurance company, is not coming from the index, it's actually coming from the FX, specifically in terms of being long the US dollar. And that's where the Taiwanese insurers have obviously been hurt the most, on their long dollar trade effectively. Now, going back to the US, foreigners are conditioned to be exposed to US assets, and for good reason. The US is still one of the best places in the world to do business. It's got the best companies in the world, and it has the best and deepest capital markets in the world. However, the Taiwanese dollar strengthening by 10% in a month, just as an example, is problematic if you are a Taiwanese holder of US assets. So the hot money was actually flowing into the US and now has started to reverse back into Taiwan. Why? Because the insurers need to rebalance into their local currency. Now, okay, Taiwan is not a systemically important country, but we saw similar moves in the Korean won and in the Singapore dollar. This is actually, interestingly, the opposite to what happened in the Asian crisis of 1997. So will this continue? Well, let's look at some other numbers. Since 2019, there was $10 trillion worth of inflows from abroad into US equities. The biggest story here is obviously not Taiwan, Korea, Singapore. It's actually Europe, because the majority of the $10 trillion came from Europe. Now, in a similar way, the euro is up 10% year to date versus the dollar. So a similar situation to Taiwan, but of course in a much larger scale. As you can see from the chart on the screen at the moment, between 2012 and 2022, US equities ranged from about 52% to 57% of global market capitalization. However, since 2022, US equities have gone from accounting for roughly, let's say, average 55% of global major equity market caps to 66%, which is an all-time high. Between 2022 and the end of 2024, the US stock market added about $20 trillion in market value. This is more, for example, than the market capitalization of Japan and Europe put together. So in the immediate future, what do we think is more likely? That the US moves from, say, 66% of global market cap to 70 or 80%, or that we get some kind of mean reversion and we return to something in the 2012 to 2022 range, when equities in the US were between 52% and 57% of the global market capitalization. So as you can see from that chart, there was basically a range which was decisively broken out of in 2022. So how might this manifest itself? How might we return to that 2012 to 2022 range? Well, of course, it can happen in more than one way. The first way that would be obvious would be that the US loses the additional $20 trillion of market cap that it picked up in the past 3 years. Essentially, that would mean a big sell-off. Or what I think is more likely is that the US could range trade whilst other markets re-rate either through higher exchange rates, higher valuations, or a bit of both. Either way, were this to play out, being long a basket of, for example, some European names, defense, some emerging market, let's say Brazil, versus short US Mag 7 would work in this scenario. That's actually how I'm positioned, with a slight net directional bias. Here's the EWZ, which is the Brazilian large cap ETF in the US. The Brazilian market is on 9 to 10 times PE, pays out about an 8% dividend yield, and is still not actually far off its COVID lows. Now, the real catalyst that would turbocharge Brazil is President Lula losing the election in 2026. Clearly, that's still a bit too far ahead. However, Brazil has been performing well year to date, and as I say, I'm exposed to that. Brazil is also, by the way, a major beneficiary of China stimulus, if we ever get that. Now, the long Germany trade, I've got various positions on, one of which is RWE, which is a German utility. It has ADRs, so it trades in the US. It's the largest power producer in Germany, trades on about 15 times PE versus US utilities, which trade around 20 to 25 times. So, as we know, there's a big stimulus coming in Germany. If Germany continues to reindustrialize, rearm, etc., they're going to need a lot more power. So the interesting thing about RWE as well is that it's also effectively being long an out-of-the-money call option on the Germans restarting their nuclear reactors. As I say, that's an out-of-the-money call option because that's not my central thesis, but that would be an added bonus. There are so many different ways to play the massive German fiscal stimulus that's coming. So, for example, there's an ETF in the US, ticker EWG, which is basically a long DAX ETF. You can go long companies like Siemens, BASF. You can go long the MDAX, which is German mid-cap companies, which are more domestically focused. Obviously, you can go long RWE. That's also got ADRs. And also, although this has already run quite hard, I think on any weakness, you should probably be interested in looking at European defense stocks. So I'm sure that everyone's heard of Rheinmetall. It's had an amazing run already this year, but there are plenty of other European defense names out there. For example, BAE Systems, Dassault, Leonardo, to name but a few. As I say, these have run hard, so really they're probably buys on weakness. So remember, this is all part of a long-short portfolio. So long a basket of a little bit of EM via Brazil, long some German fiscal stimulus trades, long some European defense companies, against being short effectively Nasdaq 100 Mag 7. So the emphasis being we're running long-short portfolios using underlying and options with a small net directional bias. Thank you. See you next time.